All right, thank you for joining today. We are going to talk about active versus passive investing. We'll go through a couple highlights from the Morningstar Active Passive Barometer Report, which looks at how active managers perform against their passive peers. But first, a couple housekeeping items. Anything you hear today is general advice. I don't know anything about you. I can't offer any personal advice. If you're over in New Zealand, get a copy of our FAP on our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. So, all right, we can get started. And despite all the advice warnings, questions are always great. So if you have any questions, just shoot them through. As I said, yeah, we're going to cover active versus passive investing today. So hopefully an interesting topic. All right. So first, we'll just start with a definition. I don't know why it says lower the volatility of your portfolio, so don't read the title of the slide. But anyway, we'll start with the definition. So active investing, of course, is making a conscious decision to deviate from an index with the intention of achieving a specific goal. And then passive investing, we are, of course, just replicating an index. And really why passive investing was initially started, one of the big things that were touted as the benefits is it minimizes taxes and fees. And so what you're trying to do if you are a passive investor, you are trying to get the average investor return. Whereas in active investing, there are lots of different goals that you may have, but one of those goals is often to beat a benchmark, to get a return that is better than whatever that benchmark index is that represents the market you're investing. So really important point, that sort of third paragraph on there. We do need to be aware that there are a lot of people out there that say, oh no, would never focus on active investing, don't think it's a good idea. Basically all of the publicity that Vanguard and John Bogle, while he was alive, talking about passive investing, we've seen this huge shift. So a lot of people think, okay, I'm a passive investor, but it is not just security selection, it's also asset allocation decisions. So taking active bets using passive products is also an active investing style. So just something important to remember. So, and it's hard, and we'll talk about the index in general. It's hard to figure out exactly what passive investing is. Is it simply replicating the entire benchmark? So if we're looking at global equities, is it just saying that, okay, I'm looking at all of the different shares traded in the world, I'm trying to replicate that index in order to be a passive investor? Or is it making those, or looking at individual markets? So a good example is Australia, which we'll talk about in a second, but let's look at what is passive. So if we were to go out there and invest completely passively, what would that represent? Well, what it really represents is, it represents all of the shares in the world if we're talking about equity. So there is an index that's put out by Morgan Stanley, and it looks at every share market in the world. So what that means is every developed market, every emerging market. And so this gives us an idea of sort of what that world is. So if you want to truly invest passively, you truly want exposure to every share from largest companies all the way to smallest companies. Yeah, what does that look like? Well, this is what it looks like. So when we look at total market capitalization, which is how these indexes are weighted, so that basically just means bigger, more valuable companies are weighted higher than small, less valuable companies. And when we talk about value, we are consumer staples. Yeah, not consumer staples. Thank you, Adam. Staples. Sorry about that. So what we're talking about with market cap weighted indexes is, yes, we're going to put more money into larger companies that are worth more when we look at the number of shares outstanding times the price. So what the world looks like is, from a share market perspective, is predominantly US. right? So we see that over 61% of that total value of all the shares in the world, 61% of that is in the US. You can obviously see the other allocations, but once again, it's going to be dominated by the US. So that's what it means if we truly invest passively. When you look in the middle section with companies, you can see the different companies that make up that index. So, you know, some of the names you hear all the time, big US tech firms. We're seeing a lot of big US tech firms in there. So you can see what makes up that index. And then you can see, of course, the sector allocation, including, as was pointed out, the staples, consumer staples. So that's what passive investing is. Now, no Australian is likely going to have a portfolio like this. So what you don't see on this list of the largest countries, and quickly after we get out of that top 5, we get to smaller and smaller parts of the index. What you don't see on there is, of course, Australia. So Australia does not make up, from a market cap perspective, much of the index at all. There are, in fact, companies that are bigger than Australia's allocation. So namely Apple is worth more than, as you can see, a lot of different countries, right? Apple, if it was a country, would be the 3rd biggest country on there, which means that Apple is worth more than all of the shares they're trading in pretty much every other country other than Japan, or definitely every other country other than Japan. So what you don't see, of course, is Australia. Most Australians are very overweight Australia compared to what it is in the world index. And that, of course, makes sense. Nobody would sit there and say that an Australian should have 2% of their portfolio in Australia. That just doesn't make a lot of sense. But it is important also to realize that, you know, that is a quote unquote active decision that you are making to allocate more of your portfolio to Australia. So just remember, it's not just picking shares. There are all sorts of passive products out there. And depending upon how you allocate into those different passive products, even if you're looking at the ASX 200 and the S&P 500, and those are your two holdings, just remember you are actually making some active bets. So it is important to have that distinction. But what we're really going to talk about today is how to decide whether, if you are going to go out there and hire a manager, so whether that's a fund or an actively managed ETF, what are some of the different considerations should you go out there and hire an active investor to manage your money, or should you just rely on passive investments, even if you're making those active asset allocation decisions? So let's talk about why you may pick one investment style or the other. And we'll get into the Active Passive Barometer report in a second, but there are generally 4 different considerations that we look at when we're considering these 2 different approaches to investing. So one, of course, is the efficiency of the market. And we'll explain what that means in a second, but that can be a big driver between those decisions that you're making. So market efficiency refers to how much do security prices reflect the underlying value of those assets. So basically, to put that in layman's terms, is a company that you go out there and buy trading for what it's worth, or is there a difference between what it's worth and what it's trading, whether that's overvalued or undervalued? Now, the issue, of course, with this is, and that people are probably thinking right now, is that you, of course, do not know the value of everything. There are lots of people out there, there are lots of analysts, there's lots of investors out there that are trying to determine the value of shares, but it isn't like there's a right answer. So the way that we measure efficiency in an individual market is we look at something like the Morningstar Active Passive Barometer report. And the idea is that the more efficient a market is, so the more those securities reflect their value, the more efficient a market is, of course, the harder it is for somebody to go out there and, using security selection, beat that index. Right? So in a perfect world where everything is completely efficient, right? Where everything is always trading for the value, it means you can never beat the index. because everything is always fairly valued. So what are you supposed to do as an active investor? You can't go out there and find things that are undervalued and avoid things that are overvalued if everything's always perfectly valued. So what we're looking at there is that in a less efficient market where there are those bigger gaps, there's more of an opportunity for active management. So that's sort of the premise of this. And we'll look at the Active Passive Barometer report to see where active managers have actually been successful or not. But intuitively, if we think about it, markets that are less efficient are markets that people pay less attention to. And they pay less attention to for all sorts of reasons, right? So if you have a lot of investors, a lot of individual investors, professional investors, very focused on a market, it's more difficult for things to get way out of whack, right? So it's more difficult for things to be, for example, extremely undervalued because there's lots of people paying attention to that market. They're all spending time trying to analyze those companies. They're going to jump on those times when something is undervalued. Now, there's a lot of structural reasons why some markets get less attention than others. So the first thing is a lot of large institutional investors, of course, have large amounts of money to invest. And if you were investing billions and billions and billions of dollars, you can't invest in certain markets because there's no point, right? So if I'm going out there and I'm running this $100 billion super fund, for example, like I can't really go invest in microcap shares because I could never put enough money into them for it to make any sort of difference in my portfolio. So what's the point? So there are certainly markets, whether it is small cap shares versus large cap shares, whether it is certain countries, developing markets, frontier markets even, when a lot of investors can invest in it. And because of that, of course, there's a lot less people looking at them. And the theory behind this is those are potentially opportunities for active management. The fee hurdle is very important. So once again, when we are talking about beating a benchmark, we of course want to do that after fees are taken out. So active management costs more than passive management. Now, this was much more pronounced back in sort of Vanguard and Bogle's early days. So John Bogle was the founder of Vanguard and really actively promoted the notion that people can't beat the market and that passive investing is a good approach. And interestingly enough, and it's the best approach for most people is what he said. And interestingly enough, Vanguard actually does run a fair amount of active money as well. They do go out there and invest, but they're really known for those passive products they have, originally funds and now adding ETFs to them as well. So obviously we want to look at the fee hurdle, right? And so we're paying a lot more for active. How representative is the index? So basically how representative is the index means if we are looking at the overall opportunity to invest, does the index make up a large amount of the securities that are out there? So very simply, that index that I just showed you before, well, that represents all of the securities that are trading out there, right? That is the entire market. But there certainly are things, are situations, especially in fixed income with bonds, where the index is not that representative of that overall universe that you can go out there and invest in. So if it is not representative of the index, meaning, let's say there's 100 securities out there and the index only has 10 in them, so, right, there's a bigger opportunity set for an active manager to go out there and find things that are different than the index. And just the ability to have that difference means that you can actually outperform. So in not very representative indexes, active potentially could be a better selection. And then liquidity. So liquidity just refers to how often those shares are changing hands if we're looking at shares. And basically what you want for a passive investment is you want a very liquid market. And the reason you want that is because as a passive investor, we seem to forget sometimes, I think, that this is actually hard to do. And it takes a lot of systems and processes and work to represent and get the same return as an index. It's not something that you can just like easily do if you are the company running these funds and ETFs. So, but what you want is a very, very liquid market so that when there are changes in that index, you can quickly move out of one investment into another one, right? To minimize that tracking error or the difference between what the index performance is and what the investment performance is that's tied to that index. So in situations where it's very hard to go out there, that not many shares, for example, change hands, like if you're in a small cap space, for example, it's harder to enter and exit those positions without moving those share prices. And it's hard to do it quickly. And you want to do it really quickly because the index just changes, right? And you want to quickly represent that index. So that liquidity piece is important as well. So those are some of the different considerations if you're deciding between active and passive. And one really important thing to say is that there's no rule, there's no reason why you can't use them both in your portfolio. If you think there's an opportunity where active management is better, you could use active products for that portion of your portfolio. But then if you think there's no way I'm going to be able to, or anyone's going to be able to beat the S&P 500, for example, 500 biggest shares in the US, then maybe that's an opportunity to go buy a passive product. All right. So the Active Passive Barometer Report, something that we put out, sorry, there's a lot of words on this slide, but hopefully I'll simplify them, something that we put out once a year. And what we do is we go and we look at every year, we go and we look at all the active funds and see how they perform against their index. Are they beating the index? Now, that isn't the only reason why you would invest in an active fund. There are other things that you could try to get out of that, namely low volatility. So potentially, if that's something you're interested in, lowering how much your portfolio is going to bounce around, particularly when you're approaching a transition to retirement, for example. You could go out there and you could pick an active manager because you wanted to generate income from your portfolio. So there's all different reasons you might want to do it that are specific to you. But we just look at that performance. Now, one thing you hear a lot from active managers is you hear that, active management works very well in times of market stress. So when everything's going up, like fine. But when, the proverbial, what hits the fan, that's when you want an active manager. Well, we've had a tough 2022, I think, as everyone is aware. So both the share and the bond market have had a very tough 2022. And basically what this quote from that top bullet point, what that quote says from the report, is that active managers have not, in fact, done well during this period. So this idea that when markets are falling, it's this stock pickers market has not played out. So basically what you can see is that active fund success rate actually fell in 2022 compared to 2021, where the market was just marching higher and reached a new high in January of that year. The other thing to note is, and this is publicized a lot, is that if we go back and we look at active management and the dollar return versus the fund return, that the dollar return has done pretty well. So basically what it implies is, you see at the end, investors like cheaper, high quality funds. Which is interesting and important, and those cheapest funds actually do better. So when you're starting to look at how much it costs, how much you're paying in a management fund, that cheaper funds do better than more costly funds. So sitting there and looking at that fee is important. So how did things go? So let me explain this chart for you. So basically what this chart is looking at, and this is a US report, but I think a lot of the implications, of course, correspond to investors here, right? Because we're looking at, when it says US on here, well, a lot of people have money allocated to the US, and it's whether you're going to use active or passive. But just remember, when we start looking at foreign in here, they mean international from the US. So what this shows is it shows a bunch of different categories that Morningstar has for dividing up funds and ETFs. And it looks at the percentage that an active manager beat a passive manager. And so what you can see is that when we go out and look at a 10, 15, 20-year period, but really what we've highlighted, what we've highlighted is this 10-year period. We go out there, we realize that not very many active managers are beating their benchmark. So basically what this says, and we look at US large blend, so that's value and growth, only 18.4% of active managers are beating the benchmark. And that's in the lowest cost. And then of course, when we get into those highest cost funds and ETFs, we can see it's even lower. So a couple of things should stand out in this report is that there are only a couple categories where more than 50%, more than half of the managers are out there beating the benchmark in the low cost. Portion. But what you can see almost universally, right, is that as we get into parts of the market where people pay less attention, like small, right? So these are small companies, low market capitalization. We can start seeing the percentages are generally higher than anything that we are seeing in larger and mid-cap companies. We can also see, and we can see the same thing internationally, right? So foreign small blend, those are small companies. They manage to hit 50%, we're only 35% beat there. And then we see a couple areas where passive or active does do pretty well. Some of the fixed interest categories, and those are those indexes that are not very representative of the opportunity set, the total amount of bonds you can go out there and buy, we start seeing those numbers tick higher. So you're starting to look at, okay, maybe these are the categories where there's more of an opportunity to go out there and find a manager, right? As opposed to here, US large growth, only 12% of the managers managed to beat the benchmark. It's very, very difficult for you to go identify those 12% that beat the benchmark over that 10-year period. So something that's important to consider. So, this story that Bogle popularized and, what we hear about like active investing doesn't work, for the most part, he is absolutely correct, right? That active management does not work, is not worth the higher fees, not worth potentially higher taxes as well, as those managers sort of churn their portfolios and distribute those tax outcomes to you. So yeah, that's what we saw. The other chart I want to put in here from the report, and anyone who's interested in the report, just shoot me an email, mark.lamonica1@morningstar.com, and I'll flip the report to you. So once again, it is a US report. It's data as of June 30th, 2022. So it's a US report, but the implications are all the same for Australian investors. The other thing is these are 1-year success rates. So remember, this is a very short term. We don't like looking at 1 year because frankly, it can be dumb luck if someone beat it. We want to look at those managers that are able to continually beat the market over a longer period. What you can see is the difference between when we did this report in 2021 and 2022, right? So this is just kind of illustrating the fact that, all these managers come out and say that it's a stock picker's market. When the markets fall, that's when they add value. That's when they outperform. In many cases, we saw pretty big falls. You look at most of these, couple big gains as well, but pretty big falls in most of the categories. So once again, the implication is it is not a stock picker's market. All right. Well, that's all I was going to cover around active and passive. We don't have any questions. We're only halfway through. So if you have any questions, please feel free to send those in now. But Yeah, hopefully that illustrated a little bit of what we want to think about and consider with active and passive. So, to summarize, overall, passive is still generally more successful than active. There are certain categories, and that's where we should start looking at those certain categories where we might want to use passive or might want to use active. So once again, around smaller shares, potentially developing markets, and around some of the fixed interests where active managers do tend to have higher success rates. So we didn't have a question, which is good. So Rob's asking, any idea what the size of flow in active versus passive? So I don't have that data on me. What I will tell you is a couple of years ago, for the first time ever, passive actually took over for active in terms of the most money allocated. So it has increased over 50%. Now, there are a lot of people wondering about what the implications are of that, and there has been a lot of speculation about what those implications could potentially be. So on a year-to-year basis, we're getting a lot more flows into passive, and years and years and years of that really got us over that 50% mark. And the entire world cannot be passive, right? We do need active managers out there. We need people making active decisions on what to buy and what not to buy. Can't all be passive, but people are thinking about it, and some people are worried about the implications of having such a large amount of money in passive, and sort of how that's going to affect the internal mechanism of the share market. Excuse me, especially as shares start going down. So Gerard said, do you have a personal view which is generally better? Yeah, I mean, listen, I think from my own standpoint, I am trying to do things with my personal portfolio, and this is very specific to me. So obviously don't take this as any sort of advice, but just want to be honest and answer the question. In part of my personal portfolio, I'm trying to do something different. And it's not necessarily beat the market. What I'm trying to do is achieve the return that I need to get to my goals. What I'm trying to do is generate more income. So I've taken the approach because of my own personal situation, that, money that I have outside of retirement accounts, so outside of a superstructure in Australia, for example, that I'm using that to try to generate income, and I'm using that because I'm spending the income. And once again, that's a very, very personal situation with me and my own finances. So I pick individual shares or go out there and pick ETFs that are trying to achieve that same thing, trying to generate income. So, in that case, I am investing actively. On the other hand, in some of my retirement accounts, I am investing more passively. So more of my portfolio is made up of ETFs that simply track the market. So, I don't know if there's a good or bad side of that, if I'm really making that big of a judgment, but, passive investing is passive investing, right? If I was trying to generate income using passive ETFs, for example, hey, that's not a great way to generate income, right? You're getting the average income, the average dividend yield, which has been quite low given how high markets were, and still pretty low historically. So I'm trying to do something different. So I think there's a lot of other uses for active decision-making and investing that does not simply involve just beating the market. So I think active investing does not work well, whether you're doing it yourself by picking shares, whether you're finding a manager. It doesn't generally work well if your goal is just to beat the market, but there's a lot of other considerations that you could have as well and things that you're trying to accomplish. So hopefully that answered the question. I wasn't trying to sort of skate around it. Obviously, I think the important thing for everyone on here is to figure out, okay, what are you trying to achieve with your portfolio? Which one of these different strategies makes sense? And also on an asset class level, which one makes sense? Because you could very easily have a lot of your portfolio be passive, but also use active strategies as well. All right. Well, we don't have any other questions. Which I guess is good. But anyway, thank you guys for joining. Anyone who's interested, we are doing another webinar tomorrow, since we had to miss yesterday's and move it till today. And tomorrow we are doing, I'm looking at the schedule now, tomorrow's the 20th. Tomorrow we are looking at the energy sector. So something that has come up a lot recently. We're hearing all about it in the news, prices of energy. So we'll take a look at the energy sector. All right. Well, thank you guys very much. I appreciate it. Shoot me an email, mark.lamonica1@morningstar.com if you would like anything, if you'd like this Active Passive Barometer report, or if you have any questions. And thank you for the nice comment about the conference. I thought it was awesome too. Hopefully some people on here attended. But anyway, thank you guys. Have a great day.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.